Hello financial investors, my name is Brent and welcome to the channel. Today we're going to be taking a quick look at stock futures, which is currently up on the screen. We're going to be then taking a look at the three main indexes, taking a look at their performance for last week, and then from there we're going to be jumping over into M1 Finance, and we're going to be picking out some stocks that we're going to be purchasing here on Monday, as we're going to be adding equity into the market here and into the account. Every week we add a brand new $115.38 over the course of 52 weeks in order to max out our Roth IRA. So we will be taking a look at what stocks were up, what stocks were down last week, and just the overall performance of the account, and then making our decision on what three stocks I am planning on buying. I already have them pretty much picked out. I'm going to be buying two that I bought last week along with a new one. So that is what we're going to be doing in today's video. If you are brand new to the channel, I would really appreciate if you do hit that subscribe button below. If you do enjoy this video, find it helpful, hit the thumbs up. And if you have any comments or questions going over this video, the stock market, dividends, real estate, personal finance, drop it into the comment section below. I do read and reply to all your comments, and let's go ahead and get into the video. So stock futures up on the board, or up on the screen now, are actually rising. S&P 500 up 0.33% currently. The Dow Jones right there, same as it, 0.33%. And the NASDAQ up 0.43%. We can see some movement here in the after hours. Genuine Parts, one that I currently hold now, recent addition to the portfolio, up 1.51% here in the after hours on Friday. Jump in and just look at the S&P 500. All three of the main indexes are currently positive for the year, with the S&P up last week 0.94% or year to date 1.07%. Right in front of the Dow Jones, which is in third place right now, up last week 0.66% or up 1% year to date. And our number one leader right now is the NASDAQ with a whopping 5-day change of 1.75% and a year-to-date of 2.3%. So last week was our official first week of 2020, a first full week, and already the markets are up 1 to 2%. So very crazy. I'm not sure how 2020 will really play out, but I think it's going to be interesting as we get closer towards the end of 2020. Let me know in the comment section below. What do you think? What are your thoughts on 2020? Do you think the market will be higher, as we've seen back in 2019, up say 20 to 30%, or do you believe we will be in that 10 to 50 or 10 to 20% range, or do you think that we will be negative this year? Let me know. I would really appreciate your feedback. Now, jumping into the M1 Finance account, I want to go ahead and cover some of the main little tidbits here. If you guys have any specific areas you guys would like to see in upcoming videos, drop them into the comment section. I'm always trying to get suggestions. I'm going to try and redo some of the channel, the way that I create content on here. So if you have suggestions, leave them in there. I write down all the ideas that I collected, and I have a lot of content that I want to release going over all sorts of information. There's so much out there that I've been kind of, haven't pushed out, and I really want to create content on that. So let's go ahead and get started first of all. So we're going to be adding $115.18 into this account. That is what we do every single week. And if you add $115.38 over 52, that's going to be right below $6,000. Now, why is this number important? Well, we're using a Roth IRA. Since 2019, the Roth IRA contribution limit is $6,000 per year, per tax year. So $6,000 broken up over 52 weeks is really close to $115.38 without pushing me over. So that is how much I invest every single week in order to dollar cost average equity into the market, into positions that are currently either red, beat up, or say I'm starting brand new positions. I may in the future add say about $3,000 into this account just to bump up all positions to $400, and then add dollar cost average the remaining $3,000 into the rest for 2020. I'm still undecided on how I want to play that out, but I'll kind of make my mind here shortly, and then we'll kind of go from there. So we do have new cash that's going to be going into the account. We also have some cash on hand, which is shown up in the top right corner. Now, where is this cash coming from? $15.11. If I select activity, up at the top, we can see that Altria paid us out $15.11 from one holding in this portfolio, we were paid a whopping $15.11. That's enough capital right there to purchase a share of CenturyLink, or not AMD any longer, but a few other companies out there. So very just nice to see that this holding, which we've held in this account for about 2 years now, is paying out a nice sizable dividend of double digits at $15 there. And here, if we select the type here of dividends, we can see that this portfolio generates a ton of dividends every single month, just week after week, just pumping out dividends after dividends after dividends. So it's really nice to see that. Now we've covered the cash that we're going to be added into the account. We've covered the cash on hand and where it came from. I did make 3 purchases last week. 2 of these I'm going to be buying again today. The 3 last week that we purchased were Genuine Parts Company, Lancaster Colony, and Waco Group. 2 of these will be repurchased this week, and 1 will be left out, but we'll be buying a separate one that we've recently added into our portfolio. So now we can look at the 1-week performance. How did our portfolio change in comparison to the S&P, the Dow Jones, and the Nasdaq? And here we can see that this had a 0.87% increase. All of this was mainly market gains, and then we did have some earned dividends. We did earn some dividends in this account that have just not been paid out into this account yet. So we earned $116.60 of just straight market gains based on the equity that we have invested, and we earned $14.09 of upcoming dividend payouts, just that we own shares and companies in our portfolio that we've sat through the ex-dividend date, and we are going to be paid in the future, just not yet. So that is what earned dividends are from. So that overall, in comparison to say the S&P, the Dow Jones, and the Nasdaq, it puts us in between the Dow Jones and the S&P 500 if we're trying to measure the performance in comparison to some of those indexes. And down here, we can see that our big winners this past week was Tanger Factory Outlet, up around 7.41% there, or about $55. And our losers this week was Walgreens, down a whopping 8.55%, or about $52.37. And we can kind of see some of these other positions here also in the red, but we have mainly green versus red, which is, pretty nice if you want to see a lot of green. I myself, while I do like the green and I do like to see equity gains in the portfolio, you obviously want to invest in companies that are going to be driving profits, driving an increase in dividends, and driving earnings, because that's going to make your investments, it's going to make it easier for you to invest, hold the company that you're invested in. And if you're invested in the next 10, 15, 20 years, you don't want to be invested in a company that's paying you out a 7%, 10%, 15% yield. If it's going to go up in the air and deflate, you're going to lose all your equity that you've invested in the company, and the company is not going to pay out any dividends because it's going to go under. So it's just going to cut dividends overall. So you want to invest in companies that are sound, but they pay dividends. And all the companies in my portfolio, a good portion of them are dividend aristocrats. And yeah, I know I've kind of put out a lot of that content in the past, but that's where the account is currently with the 1 week there, and then just overall up about 32% there, and almost $800 of earned dividends in this account. Now, what I want to look at now is what companies are currently negative in the portfolio overall. This is all positions, which ones are currently red, and there's not too many. We did add a couple recently added ones. So we have Summit Property Group, which has been beat up recently. You can see a 10% change there for the negative, and it has been actually positive in the portfolio for quite a while, and it just recently took a turn for the worse, which is fine. That's really nice to see. Actually, can probably add some equity into that one here in the future. If I may actually add a little bit more equity into it, just not at this moment, but let's see if it goes down a little bit more. Waco Group, newly added position. Genuine Parts, newly added position. Altria, not a newly added position, obviously, but it has had a major recovery from being down 30% in the account, over $200 of equity loss, to now just down $30 of equity loss, and that's a huge swing in this company for the better. UGI Corporation, this is a newly added position, down about 2.59, and Chevron down about 0.38. So we do have a few positions there in the negative. Now, this isn't always accurate right here. This, for example, here shows 3M as being positive 0.39%, but if I were to click into here and show you the actual market gains, the only reason 3M is showing as positive in the M1 Finance portfolio is because we've had earned dividends of $18.93, market gains of negative $13.91, so that gives us an offset of positive $5.02, which shows on M1 Finance that this is a positive company, whereas really it's negative by about 1.67% based on the equity change in the portfolio. So I like to use my spreadsheet more for a realistic view of the equity difference in the stocks. So the three positions that I am planning on buying were, again, Waco and GPC. So these two positions here, they're down in the portfolio. They look a lot further down here than, whoops. So Waco shows as being down 9.32. Genuine Parts shows as being down 8.52. This isn't showing that. Genuine Parts is actually up in the after hours around 1.5%. And this is showing it only as being down 4.76, and the Waze, that's down 5.23%. That's not too bad overall. They're now offering a 4% starting yield versus my buying yield of 3.81, which I just started buying this company because I see this one turning around. I see it really beat up here in the short term, but I do believe in it here in the long term, in the grand scope of it all. So getting a 4% yield versus a 3.8 is going to be huge here. 3.08 versus 2.94, not big, but not terrible. And the other company that recently took a dip, which I recently added to the portfolio that I want to continue to buy more of, is UGI. This is a utility company, so this is down about 1.58%. So I covered Waze and GPC last week. I did not cover UGI. I figured with the new purchase this week of UGI, I should at least kind of cover some of the information that kind of attracted me to buying this specific company. So overall, looking at the 1-year chart, we can see the yield here, 2.74. See if that's correct, 2.95. So it's very close to 2.95 right now. It's more accurate at 2.95% versus this is showing 2.94. We can even go to dividend.com and type in UGI, and this will kind of give us an even, a second opinion. So UGI trading around 2.88% starting yield. It has a payout of 0.325. Actually, I could have just grabbed it up here, right there. Annualized payout of $1.30. So I can just go $1.30 divided by their current price of $44.10. Multiply that by 100, and that gives us that 2.94%. So 2.95 is their current starting yield. So this is actually correct. So, whatever this is showing. So think of this as almost 3% up here. So I'm buying this at a very nice starting yield in comparison to the past year. Now looking at for the 10-year, we can see here that price has came down. It's touching its past support over the past 5 years. Back in 2018, you can see this company was going higher, had some issues, and it fell back to this $44, $42 point. Guess what? Look at this huge recovery here, $55, $56 here, just over the course of 2018 to 2019, and now it retreated back here to that 42, 44 support level again, and it's offering a nearly 3% starting yield once again. This is a good buying opportunity for me. It's not going to be something that I expect a high level of return here in the short term, but if I can add a good sizable amount of equity in this portfolio, over the long term, this company will turn around. It'll continue to grow and pay out its dividend because it has grown and paid out its dividend for the past 33 years, making it a dividend aristocrat. And it has a very low payout ratio of 57.0%. 2002. Here we can see the trend back after the recession took place. Look at that spike there in that dividend. Very nice increase in their dividend. Here, recently, they increased their dividend by a nice spike again. So they do have quite a bit of earnings. They do have quite a bit of payout, but that payout ratio is very nice and sizable. Let's also go ahead and show you the price in comparison to the 50-day, 200-day moving average. So here, prices, the current prices in the blue, the 50-day and the 200-day are in the orange and red. So here, recently it's been trading here below the 50-day and 200-day moving average, but over the course of the year here, we can see here that it has had a couple blips here in the past where this has happened, but generally it does recover and it does stay recovered and generally trade over that 50-day, 200-day moving average. And I'm just looking at this as this is a good opportunity for me as long as I believe in the company. If I look at the, so it's a utility company. I'm not going to look, I don't know if the price of sales would make sense in this, but here, okay, so it's a 1.0 price of sales. I'd say this is probably more of a book value company. So you want anything book value around 3% or 3 or less for a utility style company, and both of these are under 3, price of sales at a 1. So you're basically buying this price for its sales ratio, and its price to book is at a 2.4, so below that 3, which I like to see as sort of a little discount there. So just kind of there. Return on invested capital, I'm not looking at this as a huge one. You can see recently it has been taking a bit of a dip. That could be what is driving the price even lower, but this is a utility company. It's one of those niche ones that once you're in, you're pretty much in and set, like monopoly style. There's only so many utility companies in an area that you can invest and get your utilities from. The total assets and total liabilities, so assets 13.35 billion, liabilities 9.51, so higher assets versus liabilities. If we look at their operating income and capital expenditures, so how much are they bringing in versus how much are they losing? So it looks like their income is going down shortly. Here we can see some negative here. So for the most part, just kind of looking at this trend line, it goes up and down, up and down, up and down. Right now, they just expected they have a lower low. So back here in what's 2018. So this is probably what happened before. This little dip right here was probably this. Their operating income probably dropped. So their stock price dropped. Then their operating income re-increased. Guess what? Their price re-increased right here. Their operating income dropped down. Their price fell really hard. So that is, kind of just put it in line there with the price, with the capital income and expenditure. So in the long-term debt is pretty high. Utility companies generally are going to be carrying quite a bit of debt. If I compare this to, say, the Southern Company, or let's see, what's another utility company that I have in my ED. So another one here, ED is another utility company. Let's take a look at the debt in these ones. So here, between all of these, UGI has the least amount of long-term debt at $6 billion versus Consolidated Edison at $20 billion and the Southern Company at $46 billion. So that's just kind of putting these, I'm just giving you a comparison for other ones. So you can see here that 447 million, 1.39 billion, and 895 billion. So they all have long-term debt. It's pretty normal for utility companies. So that is what I wanted to show you. I wanted to compare it with other utility companies. That way you don't just look at it and be like, oh my goodness, that's a lot of debt to have long-term. So that is primarily what I want to cover here. That is going to be a new purchase for this upcoming week that I haven't really discussed here on the channel, and I wanted to cover it here using Y charts because I think it gets the point across, doing a little bit of a deeper dive with all you viewers, subscribers. So if you did enjoy that, let me know in the comment section below if you enjoyed doing a deeper dive into specific companies. If you guys would like to throw some companies in order to look at Y charts a little bit deeper, we can also do that as well. So drop that into the comment section, and let's go ahead and make our buys. So we are going to be buying Waco. We're going to be adding that $115.38 plus our $15.11. So it makes $130.49 split by 3. That's going to be at $43.50. So way go. I'm going to go ahead and put in $43.50. Gonna go ahead and, oh, that's not going to let me do it because I only have this much cash on hand. So what I need to do now is, that is unfortunate. So I'm gonna have to change my strategy of depositing every Friday and then making my buys every Monday. So that right there, that's a gut punch. I have to change that. So I am going to be buying. I was planning on buying, what were the three? Let's look right here. So I was going to buy UGI, I was going to buy Genuine Parts, and I was going to buy Waco with $43.50 into as much as I could into them, kind of averaging into these at their lows. They're currently negative in the portfolio. That just means that I'm buying them at a cheaper discount than where I originally thought they would have a really good valuation. They are offering me a higher yield on cost. I am buying more shares of them than I could in the past, and I'm just increasing my overall dividend income going forward by a more substantial amount. So I'm really hoping to kind of push more equity into these companies. That way I can get them up to par with other holdings, and that as these recover in the future, say as their operating income does bounce back and increase, I can see a sizable amount of invested capital return back to me. Plus, I'd have locked in that 4%, 3%, yield. And that's going to be paying me out into the foreseeable future, just straight dividends. So, unfortunately, I'm not going to be able to make any buys currently, and I will just go ahead and make these hopefully in the morning as the capital gets invested into the account. Then I can do it. I also am going to have to change the days that my transfer here takes place. So that is going to be pretty rough. So okay, so that is all I can sort of cover in today's video. Again, stock futures looking pretty positive. Let me know in the comment section below, what are you planning on buying? Do you like the new changes with M1 Finance that did this, where you have to have the capital in the account before you can make the buys? Or did you like it the previous way, where you could pre-plan your buys without having the cash available, and then when you have the cash available, M1 Finance would let it ride and just buy? So that is going to be it for today's video. If you guys did enjoy this video, again, hit that thumbs up button below. I would really appreciate to have everyone that watches this video hit that thumbs up. If you guys have not yet subscribed, definitely hit that subscribe button below. It is red, big ol' button there. And again, drop me a comment, whether it's over this video, the stock market, dividends, real estate, some video you would like to see posted here on the channel. And that is it. Thank you all for tuning in. I will see you next time. Have a great day. Bye.